Hello, good afternoon. Very nice to see you. And sorry, I can't really see the people in Zoom, but I hope that you can at least actively participate by sending your questions during the presentation. And then afterwards, Anu can have those questions forwarded. And actually, the title of the today's session is not so important at all, because you will have 4 trainings, and those 4 trainings will cover only the surface of early stage investments. And so I just put the title as How to Understand Venture Investments. And there are like 2 parts in my presentation. First, I will go into very basics for the fresh business angels. And then let's look at the trends, some stats, and trying better to understand the venture investments landscape in Europe. And very briefly about myself, I was happy and lucky to be a managing director for EstBAN before Anu. I was happy to recruit Anu to take that role after me, so that I have a very close connection to angel networks and a very still very warm heart for that. And luckily also I was able to be one of the first lead investor for the EstBAN angel syndicates. So, and lucky to be again a lead investor for the Latitude 59 angel syndicate, so that it's a sort of a small commercial also here before the presentation, so that keep an eye on the Latitude 59 syndicate and the pitch competition, so that maybe that we can go invest together. And about my background, currently I'm chairing UniTartu Ventures. That is a very early stage venture vehicle, so that it invests the intellectual property that is generated in the University of Tartu as an asset into the early stage companies. And we are building up a really good system for that for all universities and research institutions in Estonia, and probably also for the larger territory as well. I have been a investment committee member of the largest deep tech investor in Europe, that is European Innovation Council's fund, that has 3 billion euros under management. And that is also the reason why I believe that the European tech companies are in a very good state to be invested into. And briefly about that also a little bit later. And my other activities have always been lined up and listed up here, so that I have a sort of a dual background as an angel investor, but also as a fund manager. I have managed 2 investment funds. Actually, I founded also those investment funds. And in my portfolio, there are currently approximately 30 plus companies. So if you want to know more about myself, then just feel free to ask the questions afterwards. So, setting the scene, I would like to share a bit of my personal background, my experience in those fields. So, what is the need for venture capital? What you should think and not think of the startups as an asset class? Then what are the trends and stats? Why do we especially should love the European tech? And then rather a hypothetical or theoretical question, to be or not to be. It can be also translated do or don't. So that if you think that whether to invest or not to invest, so that to be or not to be is a similar philosophical point to be taken. So, as the training is meant for fresh business angels, then very briefly about the definitions. Actually, I have a significantly longer training session also, like 3 hours, so that, but we'll keep it only for an hour today. So, but still some definitions. What are the startups? And if we compare them to newly founded or newly established companies, so what is the biggest difference? I like the definition by Eric Ries, who is a sort of a legendary man for the founders. And he has defined that a startup is a structure that is designed to create a new product or a service under conditions of extreme uncertainty. So basically, that says it all. Startups are the companies that are operating in the status of really high risk. And the term startup is reserved for companies that are innovative or who make use of new technologies that also imposes a certain degree of risk. And they have to invent their own processes and their own business models while using that very often new technology. So that is the biggest difference if we compare the startups with just newly established or founded companies. And we'd like to believe that venture capital is then the risk-taking capital, but not only the capital, but the money and the resources that are made available to startups for that exceptional growth. But it also means that exceptional risk. So please bear in mind, so not only the money, but all other resources also. And those other resources very often define also the success rate for the startup. If we go further, that is one of my favorite pictures. So that is a typical startup financing cycle. And if we start from that very, very early stage, then there's something called as Valley of Death. And that is usually the period when the most of the companies in the early stage die. And these companies not die because they don't have an access to capital or they run out of money, but they die because the founders get tired. So that it's not usually the investors who plug off, but these are the founders who are not able anymore to fight with those extreme risks. So, where do we start? If we start from the very beginning and think that what are the resources for the startups to fund their activities, then yes, in that very early stage, there are also grants available for some cases, but very often the very first source for the startups are the triple F or quadruple F. And I always ask that what do those 3 Fs or 4 Fs stand for? And despite that Anu told me not to ask the questions from the audience, I still do. So what do the 4 Fs or 3 Fs stand for? So the first is for family, friends, fools, I always get it, fans. So it's almost 4. I can define also 5, so that actually founders is the first F. So that the founders themselves are usually the first source of capital also. Not only the energy, but also the money that they invest. Then, yes, it's true, it's friends, family, and then the question is that whether it's fools or fans. Because if I am a founder, I hardly want to be fools in my company. I would like to have the fans investing into my company, not the fools. And usually if the investor is a fool, it's very difficult to cope with the investor. So my first recommendation is don't be a fool. So that if there was the title of today's session, what are the do's and don'ts for an early stage and fresh business angel, then my first recommendation is don't be a fool. So, and today, I'm just going to give you some insights how not to be a fool. So, but the triple F or quadruple F is a very good source of capital for that early stage. But what is the better source of capital than those friends and family and fans? Sorry? Lottery! Yes, lottery is definitely a sort of a non-dilutive capital. Revenue, exactly. So the customers, the early adopters, is exactly the source that you would like to have the capital from. And why is that? And why the investors also love the early adopters as the source of capital? Because that gives them the feedback from the market that the customers really love that service or that product, that they are willing to give their money to that early stage team So it means that the team is probably solving some kind of a problem. It's a good thing. So the next focus area that we are talking about, if we move further, is all kind of capital at risk. When we started with the startups and the venture investors, then capital at risk is a sort of a broad term. So we can talk about the retail investors as crowdfunding platforms, for example. Then we can talk about business angels as me and yourself. And then about the syndicates, that are the groups of business angels investing together. And then there is also something called not a fund. What could it be? What is a not a fund? Exactly. It's not registered as a fund, so that it doesn't operate like a fund, but it is pretty much a pooled capital that is used for the same purpose. And very often the investors that collect the money as not a fund, they want to have a sort of a difference from a fund. Very often the fund investors are considered like a different type of animals than the professional business angels, for example. And professional venture capitalists, they tend to define themselves also as a different kind of animal. They define them as professional venture capital investors. So the professional venture capital investors as such are basically the funds, so that these are their funds. And the funds can have different type of strategies. We are not going into that field, despite that I could talk about that for hours. And how the funds are set up and what are the differences between the funds and between the syndicates of business angels, for example. And then there are also some other sources of capital defined as other. It can be CVCs. CVCs are corporate venture capital arms of large corporations, usually. And also all kind of M&A activities can also be a source of capital for early stage companies. So let's move further. What is the specifics of venture capital if we compare it to other potential investment vehicles or instruments? There are some defining features, as venture capital focuses on early stage tech companies that have potentially the global reach, high growth rate, and scaling business models. There is a long-term perspective to earn equity returns, and potentially those equity returns that are high returns are rewarded, or the high risks are rewarded with high returns. And usually the venture capital investors want to be actively participating or actively involved in developing those portfolio companies in order to increase the potential for success. So that if we compare, for example, the business angels as active investors and retail investors as, for example, the participants on the platforms like Funderbeam, or like we consider the crowdfunding platforms, what could be the major differentiator is the level of activeness. How much actually the investor can be involved in helping the team to succeed. So try to define it for yourself. What could be your level of activeness? And probably my next do as the recommendation for a fresh business angel is define how active do you want to be. So that if the first was don't be a fool, then the second recommendation would be active. And if we compare then the venture capital investments as investments into a certain asset class, and if we want to understand that how attractive those investments are, then definitely the early stage investments into startups are of high risk. And we would like to see that high risk is also rewarded by high returns as it is a sort of a normal investment logic. To earn higher returns, you should accept higher risks, whether it's also reciprocal, so that if you accept higher risks, whether it is related with higher returns. And that is the bad news, not always. So my next recommendation is, don't assume that investing into startups will provide you with high returns. You will be accepting extremely high risks. It doesn't mean that you will be generating extremely high returns. And therefore, I have the graph. And the graph is basically about it's not like the most recent one, but it doesn't matter, because there are always fluctuations in the market, but the logic is pretty much the same. And you can see that basically the top VC returns are above the public market returns, but the medium VC returns are not above the public market returns over the time. So that, what does it mean? It means that you, as the business angels, accepting very high risks in that early stage, can potentially earn high returns only if you are able to enter into the best companies. And usually the top quartile VCs are able to enter into the best companies. Then I would recommend so that try to find the best VCs or the best co-investors or the best lead investors to co-invest together to get into the best companies. Otherwise, you can end up with accepting the high risks without high returns. And if you compare so that whether startup investments and venture capital investments are for you, then just keep in mind a couple of things, like the liquidity for the early stage investments is really low. The exit event usually comes after several years, and usually the rotten tomatoes or rotten apples occur faster than the best ones. So that during your path as an early stage venture investor, as business angels are all venture investors, first you will be accepting losses, and only after that potentially positive returns and gains. So don't expect that the path will be smooth, is my next recommendation for you as fresh angel investors. So as said, if you are investing into public assets, public shares, you can basically exit any time. But as an angel investor, there is low liquidity and a long time to a fruitful exit. And as said, bad news, the majority of the startups fail anyway. So there is no gain. And we hope all that there will be high reward for high risk, but it may also not happen. And that is the reality. Reality hits hard. These are the actual numbers based on the US early stage C-Tech companies, so that it was an analysis that how many actually of those over the years are able to survive and fundraise within the different rounds. And if you look at the picture, so it's a crusher, basically. It's like, it's a coffee grounder, so that it will really make the best out of it to become the unicorns, and all others will be basically split out. So that the failure rates to raise additional round of capital are really high, and only 1 to 2% make it actually to the unicorns. And there is no reason to believe that the Estonian or European companies are so much different of the US tech companies. But still, there is some hope. And the power of law of venture capital is actually that even illustrates it better than the grounder. And if you look at the graph, there is basically 3 startups in 100 that will reach a 100 million euro valuation. And 80 out of 100 never get past the seed stage. And we, as business angels, we mostly invest in the pre-seed and seed stage. And based on the statistics, be aware that 80% most probably of your invested companies will die sooner than later. So, next recommendation about do's and don'ts, don't be over-optimistic. If we go further, I hope that many of you will become professional venture investors. Professional business angels, it means that you will build up your portfolios and you will manage your deal flows as a professional venture investor. And it doesn't mean that you don't have a VC fund. Each of you will building up your own early stage portfolio. And that will be the topic of the next training session, how to build up your portfolio, what is the strategy, how to select the strategy to build up the portfolio, and how to build a deal flow. That's why I'm not talking about that today. But I would still ask you to think of the couple of really, really important issues. And these are not only like the theoretical aspects, but my very personal recommendations also. What you should keep in mind. First, you as a professional investor, as a professional business angel, I would say, you should have a strategy. And you should consider every investment against your strategy. Does it fit or doesn't it fit? Sometimes spray and pray is also a strategy, but most probably not the best one. But Ilkka probably in the next time will talk about the investment strategies in more detail. The next thing is about the timing. And usually I talk about an hour about the different cycles. The life cycle of the company, the financing cycle, the cycle of the fund lifetime, and so on and so on. But also the technologies, they come in cycles. And later on, I'll show you a graph by Gartner, so that what is the hype of the emerging technologies, for example. Think of the timing. And there are so many aspects about the timing. What is your personal time frame? How long are you willing to wait until to receive some returns? And you may know that it will take like 7 to 10 years to really have the good exits to mature. Whether you have the patience, but also the funds to wait for the 7 to 10 years until you will divest or make the exits from all of your portfolio companies. And meanwhile, probably you will be investing again and again and again. It's like a continuous cycle. So what is your personal time frame as an investor? For the funds, it's easier. Funds are time limited. But also the funds, as the early stage investors, they are forced to invest. So for you as the business angels, my next recommendation is don't be fooled by the timing. And a couple of years ago, in 2021, 2022, there was a big hype in investments in the market, and it also meant that very often the investors felt that there is a fear of missing out. So that there were so many deals in the market, so much of money in the market, and it felt like you had to decide very fast to get into the best deals. And then it was you had to decide very fast to get into any deals at all. So, and basically that was the cycle of the hype that worked against, and I will show actually a couple of stats numbers also about that later on. So think about the timing. What is your personal time frame? How do you invest as an business angel? And for how long are you able to put your money into those illiquid cases? So about the market size and growth, definitely we all want to find the best teams able to target the global markets with a high growth rates. Whether it's possible or not, you have to look at the market opportunity. And I will come back to the narrative and numbers in a couple of slides. And as for the real estate, there are three most important factors. How do you evaluate the best plots of the real estate? How do you evaluate the best companies in that early stage? Then I would recommend it's team, team, team. As for the real estate, it's location, location, location. And for the early stage startups, it's about the founders. It's about the extended team, who else are there besides the founders, and about the new hires, whether they understand who do they lack, who do they need to hire in order to have that best team to accomplish what they promise. And then there is something else that I would like to introduce to you, and that is something that all venture investors love, and that is a long-lasting, unfair, competitive advantage. What do we mean under that? Basically, it gives you the justification. Why do you invest into a certain company? If there is no long-term, unfair advantage, you shouldn't invest into that company. So try to figure out whether they have one or not. What is the secret sauce? And then I mentioned Erik Ries and Steve Blank also. They have written like a Bible for the founders. And there is the concept of different fit levels, so that you as the investors should also think of the fit levels. And these three fit levels are first, whether there is a problem solution fit, whether there is the product market fit, and whether there is a business model fit. And it also defines in which stage actually the company is. Usually we think that the early stage companies or startups are like up to 3 years old or 5 years old or 10 years old until they somehow should mature. And if there is a company in the market that doesn't have a problem solution fit, then they probably wouldn't go further. So that until they don't have that problem solution fit, they can't really scale, for example. And if they don't have the product market fit, they should definitely not scale. So my next recommendation is try to understand what is the stage actually for that company. What kind of fit level do they have? And then all the other things are simple. So basically we are looking for the solid returns, very good exits, and that there are no problems. So that usually we think of the due diligence as trying to identify whether there is the unknown that somehow could kill the company. So that the solid returns, I would ask that, what is the return level that you would expect from your investments as an early stage risk-taking investor? And that is a question. And all those people in Zoom can also think that, what is the expected internal rate of return of the investment if you are investing in the early stage companies, accepting high risks? Any ideas? 10 times money back. Not bad. Anything else? 5 times money back. What else? In percentage-wise, so that if you invest into real estate, for example, what is the rate of return you would expect? 20, that is very good. You have to be a developer, a real estate developer for that. So if you're investing in a sort of a passive way, having the I would say, like, I don't know, real estate portfolio, not being an active real estate developer, then it's probably like 11, 12%. So what is the interest rate in the bank on deposit? It's like currently it was 4% recently, so 3.5, so no risk almost. So for the real estate passive investments, not being an active real estate developer, it's approximately 11, 12, backed by the real estate. So for the higher risk bonds or debt instruments, how high it would be? It depends very much. It can be something in between, I don't know, 18 to 36% basically. But if you think that credit card, for example, in the bank is an instrument of not secured debt, and usually the credit card interest rate is 18% by the bank, and then they still think whether to provide you with a credit card or not. Is the equity investment into an early stage company of a higher risk than the loan instrument or not? What do you think? Is it of a higher risk than a loan instrument, any kind of debt rate? Yes. Why? Because all those loans are in front of your investment, basically. If there will be a case of bankruptcy, for example, then the lenders are given the money back before the shareholders. If you, as a business angel, invest into an early stage company, you are investing into equity. You're a shareholder in that company, so that basically all lenders are served before you. So it has to have a sort of higher rate of return also, because you are accepting a higher risk level. So if the banks are giving out their credit cards with no security at 18%, then I would say that yes, most probably you are expecting to earn on your equity investments more than that. It's like, okay, 20% of internal rate of return, or 10 times money back is good. If I were giving you a training on building a portfolio and evaluating the company, then I would tell you 10 times is too low. You should aim for each investment to have 35 times money back. And I can give you the calculations about that, but not today, because today is not the topic of how to build up your portfolio. But I hope that the next trainer in the next time will tell you why should you look at each of those investments individually, whether they are able to return 30 times money back. 5 is too low. Sorry for that. Let's go further. So these are basically 3 types of the early stage investors, like profiles. Business angels, as myself and as you, we usually invest our own money. So we are often semi-professional. It may be that some of us do more investments, but at least I would recommend understand the topic and don't be a fool, as said as the first recommendation. Understand the topic, so be at least semi-professional, if not totally professional. And we are very often driven by our personal motivation. Somehow we like the field of the activity, and that's the reason why we do it. Then there are angel syndicates. As said, I have been a lead of the syndicate. I will be a leader of a syndicate again. And in those cases, I recommend to analyze the profile of the lead investor to understand whether you are willing to follow or to co-invest with that lead investor, because the quality of the lead investor defines the quality of the investment process, the quality of the investment vehicle structure, but also very often the potential success rate of the company and your investment. And then there are VC funds and the fund managers that very often invest mostly other people's money, and they are mostly strategy driven. The business angels may have loose strategy sometimes. Syndicates usually don't have a strategy because the syndicate leads have their own portfolio building strategy, and usually the other angels are following the lead strategy. And the VC funds, they are strategy driven. And why it is important? And I promise that I'll talk about the narrative and numbers a bit afterwards. Why it is important? The quality of the portfolio and the quality of the investments and the probability of the returns are pretty much related to the experience and knowledge base of the investor. Whether you are investing individually, whether you are following the lead, or whether you are willing to invest your money through the fund structure where are the professional fund managers that have built the strategy. And that is the magic about the early stage investments. If the mature companies are able to provide us with the numbers, and we can look at the revenues and revenue growth rates and the EBITDA levels or the profitability rates or the profitability growth rates, and we can somehow compare those with the peers in the market or with the industry averages or with the statistical, the target levels that we seek for, then for the early stage companies, there are no numbers. There are only the stories of the founders, and you have to have the knowledge, the experience, and the guts feeling whether to believe those narratives, those stories, or not to believe. And sometimes those stories are fairy tales. And do understand whether you are told the next growth story or a fairy tale. That's my next recommendation. Do not believe all fairy tales. And first, it's mostly all about the narrative. And then the question is rather that how big is the narrative? How large is the story? How large is the market? How large are the growth rates that you are promised? And then there will be the next phase of young growth, and then there should be at least some kind of traction already, something that supports that story, that narrative. And if you go further along that growth curve of an early stage company, then the more you move, the more numbers there should come. So try to understand whether the story is backed actually by the numbers. And then when you still are with a narrative, but you can already see the numbers, then the question is that how profitable actually that narrative is. And the practical aspect of that profitability of the narrative is the unit economics. Does it work out? If it doesn't work out, even theoretically, then in practice, it definitely will not work out. So, my next recommendation is don't believe the fairy tales. And you may listen to me and think, that is really, really risky. And there are so many negative aspects. And actually, she is not somehow recommending us to invest into those early stage startups because you have to really accept high risks and the probability of earning the high returns is rather questionable. Why should we invest at all? Why should we believe those narratives, those fairy tales, and how to actually make a difference between those fairy tales and true stories to become the disruptors and the winners in those industries. And that's why I want to show you a couple of slides about the statistics, the real numbers, not to leave you only with the narratives. And therefore, I have selected a couple of slides from the Atomico European State Tech Report. And these are actually providing the needed insight. If you think where to invest, who to invest with, why we should invest, then try to understand the industry and the sub-verticals in that industry. And what is positive about the European tech and European venture investments? And I promise that I will show you a couple of stats about the current situation. And definitely in 2021, 2022, there was the big money printing in the market. A lot of money also from non-traditional VC investors was poured into the industry, into the tech companies. And therefore also the valuations were very high. And currently, after those very good years of 21 and 22, it feels like there is a sort of an ice age. So that everything has frozen. It is very difficult to fundraise. There are a lot of companies that are in trouble. There are founders that talk how difficult it is. So it's all true, because there was, I would say, anomaly. That was not a normal situation for the 2 years with a very exceptionally high money supply. And if we compare now the investment levels of 2020 and then 2023, then in Europe we still have the upward trend. And that is very positive. And if you compare it to the US or to China or to the rest of the world, then Europe somehow is an exceptional position. And therefore, I'm exceptionally glad that we have that training session for the European Business Angel Network members, so that Europe is a very good location actually to invest currently into tech and also to make those early stage venture investments. And what else? You may have heard that the early stage companies mostly fundraise, like locally or regionally. So it is really, really important to have that very early stage money everywhere available. If we talk about Estonia, if we talk about the Baltics, about the Finland, Slovakia, basically, there is no case that there are very early stage companies raising their pre-seed or seed rounds, and there are large international funds that they are able to approach from the very beginning. There are exceptional cases, but that is not usually as such. Usually the very early stage, like pre-seed seed money, is fundraised pretty much locally or regionally. And we can consider also Finland and the Baltic as the part of the same region. Slovakia is probably something different, and I'm not so much familiar with that as well. But for Finland and for the Baltics, it's pretty much the home market. And now, if you look at the graph, then you can see that mostly the European startups are fundraising from the European investors. But also it means that the regional Baltic startups are very often fundraising from the Baltic business angels. And it means also to get into the best startups, you have to invest into those best startups in the very early stage, pretty locally. So that is my next point to be taken, so that do consider that area of investment as your home market and try to figure out who are the best players in that home market or home playground for you in order to be a part of those European or global winners in 10 years? Let's go further. Very often I'm also asked that what are those verticals or those tech areas that we should look at? That is the statistics. If you look at the actual numbers and the allocation, then it seems that currently in Europe at least, the majority of the money recently has moved into climate tech and energy. So that if somebody wants to understand that what are really, really hot topics, then climate, energy, then health and enabling technologies are those that you should look at. And Estonia has been pretty much the case for the B2B software companies. And I would say that they have been really, really good teams, really good companies providing as Pipedrive or Verif, but like the recent or the all well-known unicorns that have grown out of Estonia. But most probably today, if you think of the perspective of 10 years, the best returns are not generated by the B2B software companies, but rather in other areas like climate, health, AI, that are really targeting the problems in a different way or solving the real problems currently in the world. And why do I believe it? Because again, when we look at the statistics, then somehow Europe has become to be very attractive for the best tech talent. And Estonia is definitely exceptional, as we have the Skype legacy, but it seems that recently Europe has started to do something in a right way. And if you look at that like balance, how much talent has left Europe to go to the other locations, and how much of talent has entered the European market, then the balance is for Europe. That is something that is really, really interesting. You shouldn't really think that, okay, the best companies are built in the States. They are actually built here, in Europe, in Estonia, in the Baltics, in Finland. They are built here. And the best talent is actually moving into the same fields as I just recommended to look at. So do look at those fields if you think what could be your verticals of potential interest areas: sustainability and climate, health, digital care, supply chain and logistics related or AI related to those fields, and hardware. And the AI implementation in hardware is something that is really, really growing right now. And as mentioned, somehow we can now see that there are certain innovation networks that have started to generate so many different type of really solid tech companies. And if Atomico thinks that it's because of Skype, I have no other reason to believe it. But it's not only about the Skype or only about the Estonia or Sweden or Denmark. There are almost 1,000 companies in 50 different countries that have been generated based on the legacy of Skype. And therefore, I'm extremely lucky to show our own Estonian mafia map that is also centered with Skype and how many different companies have been generated by the people that were related to Skype in those early years. And it's growing and growing and growing. And as an Estonian, I have to show a couple of stats and numbers also about the fundraising by the Estonian tech companies. So that, again, if we look at just the graph, then we could say that there is a sort of an ice age, so that compared to 2022, the fundraising levels dropped dramatically, and not only in volume, but also in the number of deals. But actually, you have to look behind the numbers. So that my recommendation would be, do not believe everything you see. Try to understand what is behind the numbers. I would say that there has never been a better time for the early stage companies, tech companies, to build a company and to fundraise than now. And for the investors also, to invest into those companies as now. Because in those hype times, it was very easy to get fooled. And if there was FOMO also, and you felt like I have to get into those companies, you didn't really do your due diligence, you didn't really do your homework, trying to analyze whether those teams are the best ones to get into. And now the teams, the companies that are fundraising are actually doing very good job by themselves, and they are actually the good teams that are able to fundraise. So for an investor, I would say it's a significantly better time to select between those companies because the weakest ones are already out of the market. So do look at the current teams fundraising, trying to understand whether they fit with your investment strategy. And I would say pretty sure that the quality of the fundraising teams in average is significantly higher than it was 2 years ago. And that is again about the specifics of the Estonian tech-related companies that have been fundraised, and the numbers as such of that 2022 of a very high number is actually related to one company in a significant proportion. And that company is definitely Bolt. If we exclude the amounts fundraised by Bolt, the picture would be totally different. And there wouldn't be such an high rise, but also no such a severe decline in fundraising amounts. So do look behind the numbers. Do not believe everything you see. And just for the background that is also available, you can look at the Baltic Startup Funding Report, and I'm grateful to Change Ventures that collects that information on semi-annual basis. And if we look at those numbers, then you can again see that in the 2022, the numbers were very high in fundraised volumes, and the deal numbers were high, but actually the valuations have not dropped so significantly at all. And I have also outlined here, like in my opinion, the most important aspects. So if you look at those comments, then you can see that the teams that were able to fundraise in the last year most probably had a better traction, and they were also closer to profitability. So that again, already in the last year, despite of the hard fundraising situation, I would say those teams that were able to fundraise were of a very good quality. And again, if you look at those numbers, then you have to bear in mind that a lot of fundraising is currently done, and also in the last year was done internally from the investors on board already. And sometimes also those bridge rounds were not announced. So that again, look behind the numbers, don't believe everything that you see, try to understand what are the trends actually that are defining those numbers. Okay, and now the question is to be or not to be. As the final question for my today's training session. And what I would recommend to you to take away and to think of is definitely VC investments are not dead. Despite of the statistics that you see with a very high volumes in 2022 and a severe decline in 2023, the best teams are able to fundraise, definitely. And if you are investing, then most probably you can get into the best teams. And it seems that Europe can somehow offer certain advantages in tech and early stage venture capital. And to get into the best teams, you actually have to enter early. But to get into the best teams, you have to cooperate with somebody who are offered the best deals and who actually already has some experience in building up their portfolios, in defining their strategies, in taking the lead so that you can follow them, you can co-invest, and you can start to build up your own portfolios as the fresh business angels. And pretty much my time is up, despite of the fact that Anu took 5 first minutes. So these are the 5 last minutes I would take for the today's training. And that is something to ask you to think along about the future of venture capital as an asset class, or as the instrument investing into startups as an asset class. And these are my personal bets pretty much, so that it was very obvious in 2021, 2022, that the supply of capital at risk is increasing. And if you look at the stats again, then I would say that serious investors, they are not frightened by the turbulent times that were there. And actually the money is returning to the VC investments. And even more than ever, the family offices, the very large investors are willing to be a part of those early stage tech companies. But their early stage is not the pre-seed and seed investments as we see as the business angels, but they would like to enter with the tickets of 10 million and even more. So that if you are not competing with them, try to be ahead of them. Then there is a tendency also that the largest fund managers understand that the time frame of 10 plus 1 plus 1 for the VC funds is not enough for the best tech companies to be built and to be exited. And therefore, there are emerging evergreen funds that have a longer time frame or that don't have a sort of a time limit at all for the most promising, but also for the most innovative and most risky tech companies. And there are also side funds of the large VC funds as the limited partners, as the investors in those VC funds, trying to enter also that market and being like the followers or the co-investors of those best VC funds. So as I said, that the non-traditional investors try to enter the VC market. And there are secondaries fund. There are currently only one secondary fund in Estonia. It's a Siena secondary fund. But they have built a very nice portfolio. They have bought themselves into the unicorns already, so that there are different ways of investing into those early stage companies. And despite what I showed you on the graph, that the public market returns can be higher than medium VC returns, you are able to build your own portfolio. And with that own portfolio, you may be able to outperform the public market returns. Even if you are not part of the top quartile VC funds, you are still able to build your own portfolios that may outperform the public market returns. Therefore, I say that the venture capital investments into the early stage tech companies are still rewarding the high risk. So, and what else about the Europe? There is a very strong focus on deep tech, and European Innovation Council Fund as the biggest early stage deep tech fund in Europe, with 3 billion of assets under management. They are forcing very much of the European tech sovereignty. so that we shouldn't be so dependable on the technologies that are developed in the States or in China. So definitely there are more investors entering that field and also more money invested into that field. And what is a sort of not the potential trend anymore, but the reality as today is that the diversity is of higher importance, that there are already a larger number of female-founded funds and female-founded startups, and that is definitely still the potential to be discovered. And green and sustainable, as you also saw from the slide, is something that is a sort of a major trend, not like a strange thing in the market anymore. And as promised, look at the different sources that you can find for the outlooks, technology, perspectives over the time. Do your home research. Try to understand what are those topics that you actually could be interested in. And Gartner provides also every year the analysis of different emerging technologies that they believe could be looked at. And you can follow and see that currently the generative AI is there like on the top. And the question is that whether it will be actually used in different verticals, put into practical use like in hardware, or whether there will be a hype, only hype. So do look behind the screens and behind the numbers and try to understand what is in there for you. And I would say 3 hot topics based on also that. What Gartner provided is AI, sustainability and climate, and health. So that if you think what kind of startups to look at, then these are definitely the 3 areas that is of my interest. Thank you very much.